Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, April 15th, 2020. What we'll do in this video is take a quick look at the broad markets, and then I want to, as I've been trying to do lately, instead of just, putting out tons and tons of analysis on the stock market, look at other trading opportunities as well. The stock market, I certainly think it's one of them, and that's why we have quite a few trade ideas that are, should profit if the market goes down. I'm going to say this too, real quick, to get it out there to be very clear, is, a lot of those trade ideas are contingent on this one playing out. In other words, SPY dropping, the broad market dropping. Most of our equity short trade ideas will either work or not work depending on that. So with that being said, you have to take a stand as a trader and an investor. I can sit here all day long, and I mean that, all day long at just about any point in time, and make either a bullish case for a stock or the market or whatever, or make a bearish case. But doing so doesn't do anybody any good. I don't like wishy-washy analysis. Now, quite often I don't have convictions. You've been a member of the site for a long time. If you ask me, Randy, what do you think of this? What do you think of that? Or, hey, you haven't talked about gold or the gold mining stocks in a while. I'll come out and say, I don't have a good read on the chart. So I move on to the next thing. There are times that I don't. So right now, I do have a pretty good convictions on where we're heading, whether I'll prove to be right or wrong. So if you have a different mindset or outlook for the stock market, hopefully you'll find some value in some of the other commodities and other securities I'm going to cover in this video. And if not, the other takeaway from this are the levels that I cover in, let's say, on the market, for example. Those are the key levels that I think will determine key support levels, trend lines, chart patterns that will most likely trigger, if you will, the next leg down if those levels are taken out. On the flip side, let's say you're bullish, and I go over the levels that I'm going to do in this video, whether it's an individual stock or the market. Those are levels that are good, very well defined support levels, like 273.57 here, or give or take 273, where you might, as a bull, want to step in and buy on pullbacks to that level. Or if we hit any of the targets. This isn't the official trade. These were the targets for the bounce. So let me just start back there. Okay, so a few weeks back, in mid-March, as we started forming the divergent low. We were extremely oversold. We had an extreme high put-call ratio. The VIX was at multi-decade highs. Everything I said, and although I wasn't screamingly bullish saying put everything in longs, I was very, very clear that the risk reward to shorting was no longer favorable. To add new shorts or even stay short, that the risk reward was skewed to the upside. In other words, market could have certainly went lower, especially if it broke, meaning the financial system, but the Fed came in and fixed. It was breaking, but the Fed threw an ungodly amount of money at it, and pretty much said, we're going to open the checkbook. We're pulling the emergency procedures that invoke powers that we were given back in the last, the Great Depression, and they invoked those. So that put a temporary floor, which I believe to be temporary. And if you believe it to be permanent, again, then we're going to go over the levels in this video. So that was back then, and what we did is we went on to hit my, at the time I listed 3 targets, and the uppermost target was hit. That was T3, which was, when I say final target, that's where I expected at best the bounce would go, and we went there, and that was about 25%. But we went on to go a little bit above that, about an extra 4% up there recently. And so the levels that I'm watching now, let's look at it through the official trade. Are this. We had, this is a big one, about 273. So that's the big level right now. It's defined by, we had a lot of support back here, and finally we gapped down below it, came and back tested again, finally broke above it. So this whole thing recently, this breakout this week, was bullish. It was a breakout above, or at least bullish. It's bullish as long as it sticks. Let me just say that. And it is bullish on face value. You broke above resistance. However, as I often say, fewer things in trading or investing are more bearish than a failed breakout, because what happens, shorts get squeezed out, they cover thinking, okay, well, that's where the market should have stopped, and bulls think, okay, well, the worst is over, the Fed has come in just like they've done every other time in the past decade. But I'll keep in mind, and guys, They were hitting it hard back in 2008. They didn't stop. They didn't even come close to stopping what happened in 2008, even after the market peaked in 2007. The market ran its course, as I talked about. So I have absolutely zero doubts that if the whole coronavirus situation doesn't get better, if everything that I think is going to happen here, which I said we've seen a recent abatement. Last about a week or two ago, about 2 weeks ago, we started seeing all these projections about peaks. Peaks in New York, peak in the U.S., peaks in the coronavirus, and we've seen some of those have come to fruition. We've seen some numbers dropping down, even though the total death toll rise, but they're looking at peaks of new cases. And again, what I said a few weeks ago, you're going to see this. You're going to get people thinking, oh, okay, the worst is over. You're going to see them buying stocks in anticipation that the worst is over, and then you're going to see them relaxing their social distancing measures. So at the end of the day, we don't have anything remotely close to a cure or a vaccine for this thing, and so as soon as people start to relax those social distancing and stay-at-home measures, you'll probably see another surge, and then you're going to have that what moment, and then probably that should coincide with the charts. What I'm trying to do here is align what the charts are indicating to me with the ebb and flow of the news. So I'm kind of really getting ahead and trying to anticipate not today's headlines but next week's, and that's what I do with the charts too. That's why I call the site right side of the chart. Anything up to the current price is right here, and anything to the left is history, and that's what you study the history of where prices were to try to determine what's going to happen on the right side of the chart, and be right or wrong. Again, I'm trying to incorporate both into there, and right now what I'm seeing and hearing in the fundamentals does mesh with my outlook, and the thing is, if I'm wrong, I'm just going to have to adjust and adapt accordingly. Nothing ventured, nothing gained. So if these index shorts and other trades get stopped out, so be it. That hopefully we'll be making some money, or at least I will, on some of the other positions that I have in various other commodities and other ETFs and things, both long and short. All right, so that's about it on SPY. I don't want to go long term. I covered long term charts and indicators yesterday and throughout the week. I did add yesterday that this was the potential fourth target. I decided to go ahead and make it an official target. May even add some more targets if we start to get some downside. I added a different stop because when you're targeting shallower targets, trading is all about using attractive risk-reward ratios. Risk a dollar to make 2 or 3 or better. Ideally, you don't want to risk a dollar to make a dollar, because if you do that, you have to have much better than a 50% success rate on your trades. Think about it. If you're only successful on half your trades, the other half fail, and you're risking a dollar, make a dollar, guess who's getting rich? Your broker, not you. You're spinning your wheels. However, if you risk $3 to make risk a dollar to make $3, guess what? You don't even have to be right half the time. You can be right on your trades less than half the time and still be profitable. So that's what it's all about. So let me just sum this up. That's that big level there is about 273, because if we break that, that would be a failed breakout. And then we had the big level, that 273-ish level with support here. We had a big gap down. The bigger the gap, the more significant the gap is. Then we came to back test it below, failed, and had a big drop after that failure on the back test. We tried to get it again and again. Finally, we got it recently. So yay, that's a breakout. On face value, that is bullish. But as I often say, you need to be suspect of breakouts that occur both while conditions are overbought and with negative divergence. So what I see, bulls see this. We all see what we want to see. A bull sees a breakout above that level, a successful back test right here after the breakout, and maybe a second successful back test. Usually, not always, but usually when you break out above a level like this, whether it's all-time high in the stock market or security or just this level, it's pretty common to come in and back test it from above, and then that back test helps to validate it, but then usually it's off to the races after that. Some you can come in back test a second or even a third time, but the odds increase substantially, in my opinion, from my experience, after the first back test. If you come again, that back test may fail. And I'm expecting it to fail. So far, when I look at it this way, again, I see a bearish rising wedge pattern right there with a breakdown, just a kickback rally that all it did is extend the existing negative divergences that were already in place at the time of the breakout. And so to kind of wrap it up here, that's it. I think a solid break below 273 opens the door for a relatively quick move down to T1, and probably at least T2 in the near term here, and then ultimately, work our way down here to these additional targets. And as I said, if you are of a different mindset, then those are the levels that I think are significant levels, and that's where, if you're bullish and you want to buy the dip, those are the levels. You buy there, that breaks, and you want to add more, you can buy there, you can buy there. But I think this could be the start of a much larger wave down. So I'm very open to adding additional targets, very open to at least a retest, if not a break of those previous lows. And I would put odds pretty good at that, especially if you're willing to hold on, for several weeks to months on a short trade here. And I do think, by the way, it was objective yesterday. And I said that when I did the video. I even added to my short positions yesterday. Is it objective right now? No, not really. Why? Because we're falling right back. We're just above support. Why short here? TA 101 says you either buy a pullback to support or wait for a break of that support to short. So it's not objective to short when you're 1% above support. But if you hold off a little bit more, you'll have broken that support. And that would be objective. So that's my thoughts there. Okay, and a quick update on QQQ. It looks to me almost identical to this setup we had back here. The bigger picture was this bullish falling wedge pattern right here with positive divergence. Again, that was the technical catalyst clearly laid out for the bounce here. I had comparable targets. They were all hit for the bounce on QQQ off the lows there. And then along the way, we have these smaller bearish rising wedge patterns, or trend lines with divergent highs. Divergent high, that was about a 7% drop, if I recall, right there. And now, watch, rinse, repeat. This looks like an almost identical pattern here. Here's your uptrend line. There's your forms a wedge pattern, complete with negative divergence. That tells me there's a pretty good chance we're going to get a break of this level. Now, when you look back here, what happened on the last one? And this is what the market does. You almost have to anticipate this when trading, these stop raids. See right back here, there was that big, same old gap that I was talking about on SPY a minute ago. Very significant gap back from early March right here, right? And just like the SPY, it came and back tested it from below, and that was, good night, to the Qs. After that, they dropped, they plunged from there about 15% or so into the lows. But that back test helped to validate that. So not only did you have a lot of reactions here to find that level as a very important support, then the gap itself was very technically significant. The back test with the impulsive rejection was even more significant. It helped to validate. These are all check marks. It's tell me one support level is better than another. The more check marks you have, the more valid it is. So then you tried to pass it there, you failed. Now here you had a little pop above it, and that's what we call a false breakout or a bull trap, and then we failed and went down. So that's another failure there. And again, and that's why you have to give a little bit of flexibility on these stops, a little room. And finally we broke out. So that's a big level right there. I want to point that out. If you're a bull and you want to look for a buyback, an area to buy back, or you're an active trader. You're not a bull or a bear. You're just trading what's in front of you day by day, and you don't care if you're long or short. You don't care where the market's going 6 months from now. You're only concerned where it's going 60 minutes or 6 days from now. Then this is your pattern. This is what you want to look at here. You have the bearish rising wedge pattern with a sell signal come on a break below that pattern, but you also have resistance not far ahead above. You can maybe, if we get another thrust up, short at resistance in anticipation of a break and or add on a break. Very good support right there. That would certainly be a first target where I expect a reaction. I would put very good odds on a reaction. So if you're a short and you're an active trader, you could cover your short there, game a bounce. How far you want to game it's up to you. You can back test that, backfill that gap right there, or that particular gap. Maybe a back test of the wedge. I don't think so. I think a bounce would be fleeting. and then down to that 1943 level I just talked about. So that's my well, I don't know if we're going to get another kickback up, but I can tell you break of this line and all those other levels that I covered on SPY and NQ and ES earlier today, that would be your sell signal. And again, I'm looking for something like this. What does that mean? From where we're at now, about 2.7% to that 203.29-ish target, and then about another let's say a little better than 7% to about 193. I probably moved that line up a little bit. We had a reaction there, but let's just leave it there for now so you can see where I think we're going in the very near term. Probably by the end of the week, Friday. Today's already midday Wednesday. So I don't always throw out those timing predictions, but I know you options traders always love that. Hey, when do you think you'll get to, on this trade or that trade, when do you think you'll get there? And so that would be it. However, what can foil that is another kickback rally up there, and that could, that could then delay things, and maybe then we gap down and don't get there till next week. But I don't think that's going to make a difference on your timing. We're on the April 15th, so depending on what contracts you're buying, I always give it a little bit extra time. Try to time it down to the minute or day when you're trading options. But within the week or so here, I think that's a pretty likely target. Okay, guys, speaking of this, I'm going to sidetrack back to a fundamental analysis for just a second here and talk, if I can find a clean board on QQQ. Okay, here it is. And we'll just use this one. There's nothing on here but Fibonacci retracements. There's that 61.8 that we were, tried to take out intraday and were rejected at, or pretty much closed right around yesterday. We're below it now. All right, so what's going on? So here's QQQ, 61.8% retracement of the drop off the highs through yesterday. We closed down only about 10.5%. I say only, but that's only 10.5% off, all-time highs. And to put it in perspective, QQQ, the bull market in QQQ, took it up for a gain of 850%. So when you look at this, you're basically within spitting distance of all-time highs. So what I want to do talk here is fundamental. I feel very strong about this. Either coronavirus just blows over, and whether it comes out, there's a lot of things that there are things out there other than outright cure or a vaccine or something similar to Tamiflu that really stops it and lets people get back to work. I've heard things floating around for a long time that there were a lot of people, including people in my household, that got pretty sick back, several months ago, before this whole thing was before you even heard the word coronavirus. And so there's talks that, hey, maybe it was around for a while, and a lot of people have had it and moved through it, and therefore herd immunity is closer than we think. That's a possibility. But the thing on herd immunity, that doesn't even really begin to come into play until the second wave of a disease. Virus, and like the flu is seasonal, this thing would be seasonal. Maybe we don't even know much about this, so I just want to say that's a long way away. But with that being said, let's just go off the assumption that what we do know right now is unemployment rate is skyrocketing. We know that. Therefore, we know consumer confidence is plunging. Therefore, take those two together in the stock market, of course, that affects consumer confidence. Consumer spending is undoubtedly going to drop. Buy all the toilet paper and hand sand in the world you want. It's not going to add to the U.S. GDP if people aren't buying cars, boats, planes, luxury items, big screen TVs. They're not taking vacations. They're not flying. That is what's going to impact GDP. So just go with me here for 1 second. So we're looking at QQQ within 10% or so, yet the S&P 500, which is really much more representative of the stock market, yesterday came within 16% of its all-time highs right there. So when we go back to QQQ, let's look what's going on. Well, QQQ is, like I say, it's not a diversified index. It's diversified in the sense it has 100 companies, but half of those are all technology companies. And of that, you have the top 10 components. Numbers may have changed over time, but the top 10 components, last I checked, made up over Gosh, at one point they made up over 50% of it. I have to check to see where they're at now. I don't know. It's been many months, maybe a year since I've looked at the weighting, but it was so top heavy among what I call the FANG stocks, FAAMG. That's Facebook, Amazon, Apple, Microsoft, and G is Google or Alphabet, the parent company. So it goes under the ticker GOG, so therefore the FANG. All right. So those two are really determine where the NDX or NASDAQ 100 goes. But remember, the NASDAQ 100 is not the U.S. economy. It just so happens that it's the world's largest companies, and they're the same top-heavy components of the S&P 500, but they have a much smaller weighting. They're not so overweighted. They're, I think, around 3% or so in the S&P 500, and you have 500 companies in the S&P 500. So where am I going with this is I'm looking at where these companies are relative to their highs. Microsoft 9% off its all-time highs. Apple is only 12% off its all-time highs. Amazon is at new all-time highs. Hey, rightfully so that we rallied. I pointed that out back right here on this day. Said, look, if anything, this was probably one of the better looking stocks in the NASDAQ 100 because people are doing a lot more online shopping. But I'm going to come back to Amazon, loop back and pick on it in a second here. There's Alphabet and there's Facebook. So let's talk about. Let's just pick on Amazon here, and this holds true to Apple and Microsoft as well. Okay, so now the economic indicators are rolling over at a rate we've never ever seen in history. This economy has turned on a dime. Usually you don't see that. Usually economy, I think you see analogy like an aircraft carrier or a super tanker turning out at sea. You're not going to see that thing turn on a dime like a speedboat. It's a long, wide turn for that, and that's usually how the economy turns. This time was different. The ship turned so fast, probably going to roll over. Anyways, consumer spending, consumer confidence, GDP, all that's going to go down. So Amazon, rightfully so, should have outperformed or held up to relative to these other stocks. But should the company be at all-time highs? Maybe. Technically it broke down, but it regained that breakdown. But this is a very bearish-looking chart to me. Amazon is a retailer. It's not considered a tech stock. It's not in XLK. Originally, people talked about it as a tech company because that was e-commerce was kind of new back then. They started selling books and they moved into other products. But they are first and foremost now a retailer. It's not considered a technology company. And so we're going to talk about the economy. Here's the retail sector. XRT gotten hammered. They're talking about death of retail stores. Certainly, there's going to be a lot of stores and sectors. I'm going to try to, if we don't go too long in this video, talk on the REITs a little bit, specifically the retail REITs like Simon Property Group, the big mall operators, things like that. I'll try to get to some of those charts, or I'll break it down, do a separate video. But where I wanted to go with this is, let's talk about Amazon. Let's talk about Microsoft. Let's talk about Apple. Okay, and let's talk about them in context of the last bear market. The last bear market in 2007 to 2008, a lot of words thrown around, the financial crisis. It was a popping of a debt bubble created by the Fed, the same Fed that's created an even bigger debt bubble this time around, and that's what happened. So we're looking at Amazon, very powerful long-term chart. Let's turn everything off, and let's just tighten up and go see what happened back then. So I just want to point out that the S&P 500 dropped as much as the NASDAQ, which is unusual during the last bear market, and that is because the banks collapsed. The banks had the biggest problem just about of everything out there because of their excessive leveraging. They were gaming the stock market using leverage ratios of up to 80 to 1 with their trading desks to game the market. They were handing out mortgages to anybody that could fog a mirror, and et cetera, et cetera. So when the housing market collapsed, they took it on the chin. However, let's just talk about Amazon here. And I went a little too far. Let's go back here, and let's talk about what happens. Okay, again, Amazon was not over, like most problems that companies had back then. They were overloaded. They had too much debt. They were leveraged up, whether not just the trading desks on Wall Street, companies in general, but no. Amazon, like most, a lot of tech companies as well, very cash rich. They don't need to issue debt. They don't, the only reason Apple has sold bonds, they started selling bonds a few years back. They didn't need the money at all. They had more cash than they know what to do with. When they turned around and said, my God, the government's created an environment, the Fed has created an environment, we can issue bonds because we are so cash flush. We have AAA credit rating, high credit rating. We can sell bonds so cheap. We can turn around and buy our stock back and use financial engineering to run our stock price up. Why not? We'll take the money out, at 2-3%, and turn around and buy our stock and get a 18-20% return on equity on those. And that's what they did. So now, what I'm trying to get at is they weren't impacted by the financial crisis because people were paying their mortgages, but it all comes back around. When you're in a recession and people are losing their jobs, defaulting on their mortgages, it's all a vicious cycle, and so therefore they buy less goods on Amazon. They're buying lower margin items. You're going to keep buying the staples, things that you need, but I want to point out that Amazon had nothing to do with the financial crisis, didn't have any properties that they were buying, any bad mortgages they held, and they dropped 65%. Microsoft fell from the highs in the financial crisis. They topped right when the market did, again because they're also top components. Maybe they got sold down a little hard, and that's part of being these high weighted stocks in the indexes. Live by the markets, die by the markets as far as indexing goes. Microsoft fell 60%. Did Microsoft have any, were they over leveraged, too much debt? No. Did they have any, homes, properties, mortgages they were holding that people default on? No. People quit buying new computers. They didn't upgrade from Windows 7 to whatever. That's free anyways, our operating system. Well, the upgrade was, but not the operating system itself. New computers, you buy a new computer from the store. Part of the price you pay is for the OS, which is, if you buy it standalone, it's $150 or whatever for, and of course that's just part of their business model. They sell Microsoft Office, all kinds of stuff. And so anyways, the point I'm trying to make here, guys, and I could go on and on, Apple. Okay, Apple, great company, right? Sure, great company, but are they going to sell they sell premium products. You can buy an Android phone from a cheap carrier or a cheap maker for half or a third of the price, fraction of the price. You can buy an iPhone. It's going to do the same thing. This is not going to look and feel sharp and snappy and all that, and it's not an Apple with that fancy branded name. Same with their MacBooks and all their other stuff. They make great products. I'm not going to knock that, but at the end of the day, they're what you'd call a luxury, more of a premium retail, kind of like a Gucci, if you will, of electronics. And guess what? During a recession, when times get tight, people they zip up their pockets, and Apple fell 62%. So what I'm trying to do here, and I'm talking probably beating a dead horse, is I'm seeing a tremendous opportunity right now. I think, and again, unless I'm completely underestimating the impact, both the current and future impact of coronavirus, I think there's going to be a rude awakening soon, especially as we're just now getting into earnings season with these tech companies and in the future outlooks. Everybody thinks, it seems to be, at least according to what I'm seeing with Amazon at all-time highs and a lot of these other companies not too far off, especially the QQQ, technology, semiconductors. There's another sector I can go on and on about, one of the most cyclical sectors out there. And I've done many videos in the past and showed you that during bear markets, the semiconductors typically fall 50 to 70% or more during bear markets. And the last bear market alone, here it was right here, we'll just measure off this point in time right here. Let me move that line, grab right around the 2007 highs, if I can grab that candle, and just show you what happens. They're not going to go up if the economy goes into recession. They're going to fall, and they're going to fall a lot harder than most other sectors. 70% drop for the same reasons. You buy less Garmin GPSs, less, you hold on to the old computer, the old cell phone, you don't upgrade. It being a very cyclical sector, what happens is by the time they realize that, there's a glut of chips on the market. I talked about that today with oil in the trading room. I laid out a trade setup. Here, we'll jump over to that since I've already, okay, you guys get my point here that I think there's a very dangerously unfounded belief right now that tech is immune from what's going on here because they don't have a lot of retail stores. They don't, you're not having a lot of airlines and things like that in the NASDAQ 100. So I think tech semis, I'll have to talk on this. I didn't, I told you guys, suspend the stops if you want. I didn't do it on the SSG trade, so that did pass our stop yesterday. I'll update that trade when I get some time. But again, I told you, do what you want with these trades. I'm sticking tight on all my shorts and even added to them yesterday. And I think this one still has tremendous potential if you gave it a little more room below that suggested stop yesterday. Where did I want to go with this? Probably should wrap it up here and do crude, commodities, everything else in another video, because I kind of went on, I just felt it's important to get those fundamental thoughts out there because of the opportunities and the way it may impact the market. And again, it's all contingent on this thing blowing over. If there's something I miss, such as, for whatever reason, people start going back to work, and I'm wrong on. I know we will go back to work. There's no doubt about that. People at some point are going to risk getting this thing, especially the healthy, and that's the thing, guys. This is a horrible disease. It is not a death sentence, but damn near it for very old people or people with comorbidity factors, obesity, diabetes, other conditions. I understand that it's a very, very bad, and it can kill the healthy as well. But at some point, you're going to see. Think about the majority, good percent of the workforce are young and healthy people, and at some point, they're going to need to get back to work. Business owners are going to need, especially to run their business. There are people happy right now. The government's giving these big fat unemployment checks, so there are a lot of people taking advantage. That can't go on forever. This country will go bankrupt if we keep writing checks like this. So where I'm going, one way or another, people are going to get back to work, but I think at very best it's a slow boot. The economy, restaurants, airline sector, things that are almost completely shut down, slowly and gradually coming back online. Not a hard coming online. I don't think any of us can fathom walking into a restaurant 2 months from now, showing up to your favorite restaurant and being told there's a 45-minute wait, like there was 6 months ago. Okay, so I don't think we're going to get there anytime soon. That's my take, right or wrong. So what I talked about here is the setup in oil that I posted in the trading room today. Now, oil had an inventory report. I threw caution out to the wind there. I said, look, inventory is coming out at 10:30. I posted it in the trading room. I said a break above the 2009 level and the trend line, but it happened right at inventory time, and the inventory report basically was a little whipsaw signal. We're back below it, but it's still a setup. We're right at that previous low, and so this is a setup, and I'll share it for you guys here in the video if you don't have access to the trading room. These are my potential targets here. I think I had it as a day trade if we had a positive inventory report, or at least a positive reaction. Sometimes it's not about the inventory report can come in worse than expected, but sometimes the market will rally on that because it's crazy. Sometimes maybe the expectations, the whisper number was much worse. But it didn't happen yet. We are out of the woods as far as the inventory report now. We have nat gas tomorrow, and that's still the first target if we get there. Where I want to go is, look, this was the recent lows. These are multi-decade lows in crude oil. And I went ahead to say this after that setup in the trading room. Guess what? The CME group, which is the world's largest exchange for futures, this is where the crude futures are trading. That's Chicago Mercantile Exchange. They are right now in the works of doing some coding changes to account for negative crude oil prices. There are talks now, there's so much crude. The problem with crude oil, this has been such a drastic shutdown in demand with planes not flying, cars not driving, all that good stuff, that they are saying that it is quite possible that producers may have to pay people to take crude. They may have to pay consumers and others to take crude because they don't have anywhere to store it. See, that's the problem. You know, and you don't shut all the pumps down on one little master switch. It's not like walking outside your house. You got the circuit breaker panel in the house. You got switch all these breakers. You can turn off the living room lights, you know, the dining room lights with each breaker one at a time. That's kind of the individual wells around the world going slowly offline. Texas has pretty much shut down production, but they don't have that big master breaker switch like you have outside it by your electric meter that shuts power off to the entire house. Had they done that early on, sure, you would have had a problem here, but you know, you kept having countries like Venezuela and Iran. They have no choice but to keep pumping, to keep the lights on. They don't have other money coming in from other sources for the most part. And so they continue to pump. They're going to continue to pump. And the problem with crude is you can't just store it in your backyard. There's only certain amount of storage facilities. Once you fill up all the crude tankers that move it around, they're at port, you know, sitting there docked full of crude oil. Where else are you going to put it? You have these big vats, you know, Cushing, Oklahoma, all these places. It's going to be overflowing soon. So I just wanted to, what I'm getting at here is do not underestimate how low crude can go. And that, you know, holds true for some other things right now. But crude, and especially natural gas, that also has storage issues. And that's why natural gas prices are so volatile. Really, it doesn't store like crude oil, for example. All right, and we'll just hit on that and maybe wrap it up so this video doesn't go so long. And I'll cover the other things in another video. I wanted to touch on palladium, the semis, look at the sector, but I already gave you my thoughts there, where they're going. LQD, palladium, gold, the US dollar, and all that good stuff. There's a lot I'm seeing in the charts now I want to cover, but I wanted to share this other setup. I posted both of these in the trading room today. In the trading room, I actually posted two charts, once here, and once again we had just pulled back again to that 1612 level right there. And it's pretty decent support. It's a level I've had on this chart for a while. Big old gap right here, a lot of reactions, and we broke above it. That helped to set that up as an important level. Pulled back to it, held it like a champ. There's another check mark. Again, what I'm doing is validating the trend line or the support level. Tried to pop it there, a little false breakout and impulsive rejection, and then finally had a breakout here, and then an impulsive move and rally. So that even though we took it out, it helps to validate that, because we didn't just limp on through there and go around like this. We broke out and exploded and went higher, a lot higher. So therefore, this is TA 101. Can't promise it works, but I can promise you this is an objective long entry here. The big problem is, well, the risk is nat gas inventories come out tomorrow at 10:30 a.m. So if you're in it, you want to take it today, you can have a stop here, but at 10:30, you know, just keep in mind, and you should have a stop. You can get a whipsaw signal, could stop you out, or it can keep going down through there, and sometimes your stop loss order won't get filled until it's beyond your stop price if the market's moving very fast. But like I said, you have this kind of price channel. Other than that little false breakout right there, pretty decent price channel, and you know, break above it if you want to play it safe. You can wait for a breakout above the channel in the 1653 level, and then you can see 1, 2, 3. I think this is my maximum target for right now, the 1735 level right there. And from a fundamental catalyst, if you might want to ask, you know, well, you know, if Randy, you're saying they're shutting down all these wells, there's too much crude sloshing around. You know, it was a member of the site brought this up the other day, a couple weeks ago on the site, is that's actually tends to be bullish for natural gas, because again, natural gas doesn't store. It gets, you know, gets moved through pipelines, and so when they shut the wells down, all of a sudden, because they shut natural gas production stops because it's coming out of the ground. You know, it comes out with crude. So therefore, and that's why natural gas is even more volatile than crude oil, moves up and down real quick. So, you know, if we get a lot more wells going offline here in the U.S., especially where, you know, most of our nat gas is coming from, that could cause shortages and therefore be bullish for natural gas prices, even if crude's going down. And how to play it if you're not a futures trader. Well, if you don't want to use leverage, you can use UNG. It's a natural gas ETN. This is a daily chart. You'll probably go to a 60-minute chart. It's not going to look exactly the same because you're seeing, trades from 9:30 to 4 p.m. where natural gas is trading virtually the futures around the clock. But so I'd have to mark the chart up here, but I can tell you right there, I can see a level about right somewhere in this area there. I'd have to study it a little further to really give you some good targets. And then there's always UGAS and DGAS. Just be careful. These 3-time leverage ETNs. If we start to see a lot of volatility, natural gas is always volatile, but these guys they're at a little bigger risk because they're ETNs number one, and they're using 300% leverage. But again, you get more bang for your buck. And don't forget, another thing is you don't have to. If NG is a little too much for your taste, you do like futures, but the NG contract moves a little too much. Then what is it? QG, the letter Q. And then G is the natural gas E-mini futures. I think it's 1/4 the leverage factor of NG. So you're risking, you're buying it at the same price. And that's the good thing about it. You can use these charts that I share, the NG charts, if I can find it again. And it's the same exact price levels. It's just the mini contract. Just like you have the mini for oil is QM, crude oil mini contract. You have minis for gold, silver, the stock futures. They all have mini contracts, and some are only 1/10 size and everything else. So, if you want to get your feet wet at futures, those are probably the way to start out. But again, it's all relative to your account size too, because even the mini contracts have a pretty good degree of leverage in there. So, and if you've ever traded natural gas, if you trade it long enough, you'll know exactly what I'm talking about. Just a single contract of NG alone, which only represents I don't know, I think it's like $35,000 of a natural gas. That sucker can swing big in a day. But anyways, let me wrap it up here because we're seeing a little movement in it off that level so far, and get this video out to you guys. And I'll try to get some in here shorter that don't run this far, and I'm also going to do quite a bit of effort to get these individual charts out, and I did earlier today. I posted 2 charts on NG already today in the trading room, as well as I think 2 on crude oil, and I'll try to continue to do that, especially for active traders. That's kind of trading room stuff. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.